India has been grappling with an interesting challenge of creating enough jobs for its ever-growing population. A study done by Care Rating shows that additional jobs in the organized sector grew by just 0.5% each year for the past 5 years, and about 2.25% if you look at it for the past 5 years. This is despite the fact that the economy has been growing at 6.5% each year. To talk about this and what are the implications are for policy decisions, Madan, Sabnavis, Chief Economist at Care Ratings, now joins us. Madan, great to have you on the show as always. We've been talking about this for a while, that we're in a phase of jobless growth. You've actually put some numbers specifically with respect to jobs in the corporate world. Can you explain what you've done before I get into the details?
So actually what we have done is we have looked at the annual reports of various companies. Now annual reports are something which give us what is the terminal point, what kind of employment or what was the total number of staff which was on rolls. And you're looking at this kind of a trend over the last 5 years to actually see in case there has been an improvement or there has been a deterioration. Now, based on this kind of a sample, it's a very restricted sample because we should remember that when we're talking of the organized sector and you're looking at annual reports, we're actually talking more of the medium and large scale companies. It doesn't really include the smaller or the micro units because we really don't have annual reports for them. So it's a very, very restricted sample. So this is what's really happening in the larger industry. This includes both manufacturing and services. And the picture, as you have mentioned, shows that definitely the growth in employment numbers are not quite commensurate with what we're seeing in GDP, which means that when GDP growth is going off at the region of around 6.5%, 7%, 8% in the last couple of years, we haven't really seen a commensurate increase in employment. It's definitely much lower than that. And a couple of points out here. One is that, of course, there's a difference in employment growth in different industries. That's something which we would expect. And while there are certain service industries like IT or banking which have done better, definitely the manufacturing sector is something which has been lagging. So I think that's a point which the headline number doesn't really capture. And the other thing, of course, is that when we're looking at these employment numbers, it's more of the organized, so we're really not looking at unorganized sectors. So when we're talking of things like, say, demonetization, where the SME segment was probably more affected, I think that picture doesn't really come out here. And we should remember that when the economy slows down, and this was a time when the economy, notwithstanding the fact that we're talking of 7% growth, the fact remains that none of us are really convinced that the numbers are actually comparable to the kind of economic conditions we had when we had 8.5%, 9% GDP growth under this new method of calculating GDP. But what really happens is that when the economy slows down, companies tend to cut down on their staff expenses. I think that's a kind of a discretionary expenditure which you have. And that's what we have seen really from these numbers, that companies have managed to or tried their best to maintain their profit margins. And when your top line is not growing at an adequate rate, to cut down on your costs, and staff becomes an easier option. So I think that's what's a combined result which we are seeing in terms of these headline numbers.
Good afternoon, sir. Ira joining in as well. On the point of the manufacturing sector, sir, is it sort of consistent across all sub-segments of manufacturing, or are we seeing a little bit of a shift? Maybe some of the traditional segments were not doing well. Maybe it's shifting towards auto, where there is activity happening. Is there within manufacturing some gradation of segments which are showing employment growth and others which are not?
No, actually, it's a case of saying it's a very differential kind of a performance. So, in fact, when we have tried to juxtapose the same with the way in which these industries have performed, we have not really seen any kind of a correlation out there. Because we should remember that even when we are talking in terms of these staff numbers, these are the numbers which are reported at the end of the year, the headcount at the end of the year. And what has really transpired during the year is something which is not known. So, some of the sectors, like, say, which you mentioned things like automobiles, consumer goods, which tended to do a bit better last year compared to the other segments or the more stagnant ones, like things like textiles, have shown differing trends. Like, for example, textiles seem to be showing just marginally positive kind of growth, whereas we don't see the similar kind of growth taking place in terms of their overall production or sales growth. So I would say that we cannot really say with any degree of certainty that there are certain sections of industry in a particular segment which have been showing higher employment growth. I think it's more company specific. The larger companies have tended to have more flexibility in terms of rationalizing the employment. In fact, even if you look at something like, say, banking, we have been hearing reports of certain private sector banks which have gone in for layoffs, saying that we've gotten technology and therefore we do not require certain kind of skill sets. So this is going to be a kind of an ongoing process, and it's going to be more company specific rather than sector specific.
Okay. There was a chart that sort of explained this from a sectoral standpoint, that about 11 sectors created 80% of the jobs, and I could see a large, there you go, finance, which I suppose includes the entire banking and the BFSI space, retail, textiles, so they were the bigger employers. Madan, one question about what does this mean for cost of employment? Are we, from the survey that you've done, has increase in wages been commensurate with the overall growth in the economy?
So given the kind of limitation we have when we look at balance sheet numbers, like when you look at the total expense on employees, one should remember that even in case there are layoffs, there are certain kind of compensations made, in which case the wage bill could tend to get exaggerated in a particular point of time. But notwithstanding this kind of a shortcoming which is there in this kind of a study, because annual report numbers only give us a certain bit of information, they don't go into the depth of it. But there is a tendency we have seen on the aggregate that average salaries or average compensation to employees has tended to increase in the last 2 years, though the pace has been lower in 16-17 compared to 15-16. So again, I would say that would tend to be more industry and company specific, and as a generalization, definitely there has been an improvement in the compensation paid, though it may not be necessarily so for all the companies or for all the sectors.
So just a clarification, so these annual report numbers would include contract labor as well?
No, this is a full-time employment. So the contract labor is not necessarily mentioned by companies, but what we decided to look at was looking at the permanent staff. So I think in case of something like mining, since it comes largely in the public sector, we've actually seen a decline in employment. So one would assume that it's more of the lower level of laborers, the lower income laborers. That is where we have really seen a bit of rationalization which is taking place on a continuous basis.
So it is possible then, sir, that you're seeing a shift in this. No, go on, sir.
Yeah, sorry, a thing which doesn't really come out here is because there's been one latest tendency which is there in companies to do outsourcing of labor. So what really happens is that a number of functions are outsourced to third-party agencies. Now that kind of an information is not really captured by the annual report, because that kind of an expense comes under your administrative and miscellaneous expenses. So while my overall headcount may be coming down, it's quite possible that with the outsourcing of certain functions, like say your security or your back office, or sometimes even your front desk in banks, what really or your credit card, people who are selling credit cards, that it could be shifting more towards a different category of expenditure. But in terms of the permanent head staff, these are the numbers which we're looking at.
Okay, news just flashing across your screen. The cabinet has approved paying outstanding subsidies to fertilizer companies. That works out to nearly 15,722 crore. That's the news coming in from Delhi, that the cabinet is going to be paying 15,722 crore as outstanding subsidies for fertilizer companies. It's approved a 10,000 crore as the additional fertilizer subsidy. Let's bring up some of those fertilizer counters. RCF marginally up. They're reacting to this news at this point in time. But that's the story coming in from Delhi. Madan, I have one final question, and I want you to sort of put on your hat as an economist. I mean, you've also been talking about the jobless growth for a long time. From whatever you've seen from the government so far, does this give you confidence that the lacunae in manufacturing jobs is likely to be bridged if some, if not all, of what the government has announced is fulfilled?
No, actually, we should remember that when the government talks in terms of investments, it's a very small proportion of overall investment taking place in the country. And when we're talking of employment, it's going to be largely what we're talking of private sector employment. Now, we should not really get carried away by these numbers which the government puts out, because while they are impressive, and this particular government has definitely met its commitment in terms of capital expenditure, but we need to see private investment picking up. I think that's also a point which we have made in our report, where it says very clearly that we need to see overall investment, especially from the private sector, pick up, because it's only then that we will see jobs being created. Otherwise, more or less, we will be seeing similar kind of trends, a kind of a gradual recovery taking place, because we need to go back to the times when the economy was growing at, say, 8.5%, 9% under the old GDP calculation method, when we did see accelerated creation in jobs. Because right now there's a tendency more towards rationalization of employment, trying to use more of technology. And even today, when we are talking of the new technologies which are coming in, most of them tend to be labor displacing, which actually is quite a scary thing for India, because when we are talking in terms of a demographic dividend, we have a large amount of young force. Right. If we're not able to provide these kind of employments, it could be leading to certain kind of social issues. And I think we are cognizant of that.
Sure. We'll leave it there, Madan. Thank you so much indeed for joining us with your views. Madan Sabnavis from Care Ratings, talking about jobs and jobless growth.